how does the approval process for a senior bridge loan consider the credit history and financial stability of the senior and their family?
So the application process, basically, we would have an initial conversation with the senior or their family or both, just to kind of get a sense of what their goals are, how much money they might need to take out, how much equity they have in their home. And then in most cases, we can tell people pretty quickly what the loan would need to look like in order to work, or if it works at all. If they like to proceed, then we would start gathering some documentation and going through the underwriting process. We would do an appraisal of the property, kind of go through the standard underwriting process that you do on any mortgage. And then once all the conditions of that loan are satisfied, then we're able to close. And then within a few days of that, the senior usually has the money to be able to provide to the community. If they need extra money to cover, for example, monthly expenses while they're moving into the community, while still having this now bridge loan to pay for, as well as, taxes and insurance maybe on their home, maybe other general expenses that they need help with, we can actually increase the loan amount, qualifications permitting, to allow them to take out extra money to cover their expenses during that window of time when they've now moved into the community and start incurring those expenses, but they haven't yet sold their current home. Once we get past the initial stages of outlining what the loan will look like and the senior and their family decide they want to proceed, the types of documents we would typically ask for would be Social Security award letters, pension award letters, VA benefit documentation if they're veterans. We also ask for bank statements to show what investments they have, maybe in IRAs or cash accounts. We're looking at the monthly payment for that bridge loan, along with any other expenses they have outside of the property. So we look at all that and we calculate what we call a debt to income ratio, which is the percentage of their income that would be used for to pay for this bridge loan, real estate taxes, insurance, and any other debt that they have. They don't have to move the money. They don't have to change anything. Just the fact that they have these funds allows us to convert, just based on an algorithm, those assets into additional income. And that's how one of the ways that we're able to get seniors to be able to qualify for more than they would normally qualify for, because traditional underwriting usually doesn't allow you to do that. You usually can only qualify off of the recurring income that shows up on paper, like Social Security income or pension income. Right. But in a lot of cases, the senior's income from those sources is not enough to be able to qualify for a 6-figure mortgage.